This episode is brought to you by Amazon Business. We could all use more time. Amazon Business offers smart business buying solutions, so you can spend more time growing your business and less time doing the admin. I can see why they call it smart. Learn more at amazonbusiness.com.
Does it ever feel like you're a marketing professional just speaking into the void? But with LinkedIn ads, you can know you're reaching the right decision makers, a network of 130 million of them, in fact. You can even target buyers by job title, industry, company, seniority, skills, and did I say job title? See how you can avoid the void and reach the right buyers with LinkedIn ads. Spend $250 on your first campaign and get a free $250 credit for the next one. Get started at linkedin.com/campaign. Terms and conditions apply.
This is Optimal Finance Daily, Why You Should Invest, Even in Peak Markets, Part 1, by Chelsea of smartmoneymamas.com. With the U.S. stock market continuing to hit new highs, I've been asked by some readers if they should wait to invest in the stock market. Interest rates are rising. We are over 8 years into a bull market, and some pundits are starting to call for the next downturn. People are worried about investing at the peak of the market, so they're holding off. But they really shouldn't be. In today's post, I'm going to break down why you should still be investing in peak markets. Timing the market is just as hard as picking stocks. But that's exactly what you're doing if you're holding on to cash and waiting for a market downturn. You're betting that the pullback will more than compensate you for the lack of return while your money sits in cash. You're also betting that you'll have the discipline to put the money in when everyone else is taking it out. So what's the problem with making that bet? You could be wrong. In every market, it isn't hard to find a Chicken Little. Someone running around telling you that the sky is falling, the market's gonna crash, and you need to get out now. Eventually, one of them will be right, but none of them know when that is. On August 26th of 2014, the S&P 500 closed above 2,000 for the first time. At the time, plenty of people were there to say that valuations were too high, the underlying economy wasn't strong enough, and we would see a downturn in the near term. Some claimed that even if the economy improved, stocks would have to drop by about half to see normal rates of return in the next cycle. But if you had listened to the naysayers and pulled your money out of the market of August of 2014, you would have missed out on a 7.8% annual return or 9.8% if you reinvested dividends between now and then. Then, in February of 2016, when the bond markets were under significant pressure, many people thought we were seeing the beginning of the next market downturn. If you had listened to the naysayers and pulled your money out of the market in March, you would have missed out on a 17.8% return or 19.7% if you reinvested dividends over the following year. If you hold onto your cash long enough, eventually you'll see the market decline. That's how cycles work. But just because you were eventually right doesn't mean you didn't miss out on a lot of growth in the waiting. Which brings me to my next point. Time is money. I've written about dollar cost averaging and why I love it as an investment style. Investing on a regular basis without concern for price is a great way to create discipline in your investment methodology and get your money to work in the market quickly. Every day your money sits in cash, you are losing value. Your checking or savings account doesn't compensate you for inflation, so the $100 in your checking account today is worth less next year. If I had $100 to invest a month, I would invest it every month instead of waiting until I had $1,200 at the end of the year. However, if someone handed me $1,200 today, I would invest it all now instead of bleeding it in over 12 months, even though traditional dollar cost averaging would recommend bleeding it in. And according to Vanguard, the majority of the time I would see better performance. Vanguard looked at rolling 10-year periods in the U.S. stock market from 1926 to 2011 and back-tested the performance of lump sum investing versus dollar cost averaging. In other words, would you do better investing a certain sum of money today or bleeding it in over 12 months? What they found was that regardless of asset allocation, 65 to 67% of the time, you would see stronger returns putting the money in the market today than trying to smooth things out by leaking it in over time. The reason for this is that the long-term trajectory of the market is up. The more time your money is in the market, the better you do. So what about the 35% of the time where it's worse? What if you're the unluckiest person in the world and this really is the market peak? History says now is almost always better than later. Investing is a long-term game, and in most cases, time heals all wounds. The secret is to hold strong through market cycles and not take your money out of the market as things get bad. However, it is incredibly hard to keep running forward when the herd is scrambling out. So to provide some motivation for you to invest and hold strong, I took a look at the last 10 market cycles. How would you have done if you invested your money on the peak day before the market turned? To be continued. You just listened to part 1 of the post titled Why You Should Invest Even in Peak Markets by Chelsea of smartmoneymamas.com. This message is brought to you by Apple Card. If you're like me, you might be considering getting a new iPhone. But have you considered upgrading your credit card? When you use your Apple Card with Apple Pay or the laser-etched titanium Apple Card, you can earn unlimited 3% daily cash back on everything you buy from Apple, whether it's a new iPhone, an iPhone case, or even a service like Apple Music or Apple TV Plus. Earning 3% back on the Apple products and services you love? It's an easy decision. You'll only wonder why you weren't doing it sooner. Subject to credit approval. Apple Card issued by Goldman Sachs Bank USA, Salt Lake City branch. Terms and more at applecard.com.
This episode is brought to you by State Farm. Checking off the boxes on your to-do list is a great feeling. And when it comes to checking off coverage, a State Farm agent can help you choose an option that's right for you. Whether you prefer talking in person, on the phone, or using the award-winning app, it's nice knowing you have help finding coverage that best fits your needs. Like a good neighbor, State Farm is there.
Fear is a strong, influential emotion when it comes to money, and none of us are immune to it. I think one of the biggest hurdles to consistently investing is the fear of losing money. And ironically, the fear of losing money may cause us to make decisions that lead to actually losing money. So for example, at the start of the pandemic in 2020, many corporations were struggling, including my employer at the time. I was lucky in that I wasn't furloughed, but I did take a 10% salary reduction, and my employer stopped all 401k matching. It felt like the writing was on the wall. I was probably going to lose my job, and it could take me a long time to find a new one. So while I continued to make my regular 401k contributions, rather than investing that money, I held it in money market. I rationalized that this would be a backup emergency fund, as I could have taken a COVID-related distribution with no penalty, and I'd have 3 years to pay the tax on it if I really needed to. And I shouldn't invest this money because obviously the economy was going to collapse due to COVID. Well, that didn't age well. Now I understand in the moment it felt like an unprecedented time and the apocalypse was upon us. But I didn't end up investing that money until late 2020, and so I lost out on a number of months of investment gains. And I simply didn't need to hoard this money. I already had a year of living expenses in cash. In fact, just 8 months after I made this fear-driven decision, I decided to leave my job voluntarily because it was clear that I had the financial bandwidth to do so. The point I'm trying to make is that it's never a good idea to make a financial decision out of fear. Well, that should do it for today. Have a happy rest of your day and a great weekend. And I'll see you in tomorrow's show, where we'll finish up this post and where your optimal life awaits.